Ladies and gentlemen, I'd like to talk to you about how the client can go long a position in a fund. And I want to talk to you about a couple of voluntary methods of accumulation to establish a long position in a fund. I mean, he can give you that one lump sum capital investment of $50 or $20 or $10,000 and say, look, I don't know if I'm going to have any more liquidity after this. I got one shot, one lump sum investment. That's one way, of course, to invest in any security. Or he could ask you a question. Can't you and I, my broker, my financial advisor, establish some plan that I can invest money in a fund? A plan that's strictly voluntary between you and I that I can discontinue. I mean, not soon after I start, without any penalty to me if I don't finish it out. Of a way of going long voluntarily, shares or to give you money in a fund. And the answer is absolutely. There are two voluntary plans of going long and establishing an investment in a fund. These plans are called dollar cost averaging versus dollar averaging. Now listen to me. They are introduced here because they were created, these voluntary methods of accumulation, strictly when they were created many, many years ago to establish ways that the client establishes a long position in a fund. But they are generic in going long any security, as you'll see. Now, the first plan, by definition, called dollar cost averaging, has the client give you Series 7 Bullet 1 a fixed cost basis dollar amount of money every month, every quarter, or every year to go long an investment and buy shares in a fund. Now, I'm just using a one-year timeline plan. Could have been a 6-month plan. Are you with me so far? Yes. And remember, he can discontinue this plan, not finish it out. Right after month 1, he has no penalty. It's strictly voluntary. This is a fixed cost basis. Giving you, in my example, I'm just using $5,000. He's going to give you every month $5,000 to buy shares in that fund, and every month for 1 year. The second method of accumulation voluntarily, Series 7, is called dollar averaging. 7, a fixed share order. My example, clients looking to accumulate and buy 5,000 shares every month in that fund for a 1-month plan. One has a fixed cost basis dollar amount of money every month, or every quarter, every year. I'm just using it monthly. One is a fixed share order. Are you with me so far? Yes. Are you with me? Yes. Watch this trade. I'm going for NASDAQ right now. Two investors, A and B, buy into the same fund with different planned investments. One client uses dollar cost averaging. Another client uses dollar averaging. They're buying into the same fund with different methods of accumulation. One client's going to give you a fixed cost basis dollar amount of money every month, and one client's going to give you a fixed share order. What you're looking at in red are the fluctuations from 1 month to the next of the prices in the fund. Are you with me so far? Yes. Both clients fulfill the 1-year plan. They don't have to. I'm telling you that they did. Are you with me so far? Yes. At the end of the 1-year plan, look up. Which client is going to end up owning shares at a lower cost basis per share? The client who chooses dollar cost averaging or dollar averaging? Go! Dollar averaging. The answer is dollar cost averaging. Thank you very much. Give me the right answer, I might fall over. You're very spontaneous today, Michael. Now let's take a look at why. Look up. This is critical for you to know. Let's take a look at the client who accumulated investments and bought shares in the fund based upon dollar cost averaging. Every month, he's going to give you $5,000. He's never given you any more than $5,000. Are you with me so far? Yes. So take a look at what happens in months 1, 3, 5, 7, 10, and 11 when the prices in that fund are the lowest. When he gives you those $5,000 during those months when prices are lowest, are you with me so far? Yes. That $5,000 is going to end up owning more shares at a cheaper price. What about months 2, 9, and 12 when prices are soaring in the fund? The same $5,000 he gives you those months, he'll end up owning less shares. Are you with me? Yes. What's fluctuating here is the number of shares he'll go long in his position from 1 month to the next. What's not fluctuating here is his cost basis. He may own more or less shares depending upon whether prices are lower or higher in the fund from 1 month to the next, but he'll never give you any more than $5,000. So the cost basis is fixed. What's fluctuating is the share ownership. Agreed? Yes. Now let's take a look at what happens to this client who says, regardless of the prices in the fund from 1 month to the next, spend whatever price that is to end up owning 5,000 new shares every month. So let's take a look at what happens to this client when he gives you a 5,000 share order when months 2, 9, and 12 roll around. Prices soaring in the fund. What happens to his cost basis? Flies high. He's going to spend those higher prices to own those same new 5,000 shares, no matter what those prices are. You with me so far? So What's not fluctuating here is the share ownership. But what is fluctuating here is his cost basis. Am I right? He's going to spend those higher prices to own those same new 5,000 shares in that fund when those prices are soaring, which is going to end up adjusting and inflating his cost basis at the end of the same one-year period of time. Any client in any investment in any security in the market who chooses to invest with a fixed share order will always have his cost basis unprotected. Are you with me so far? Now, the client who chooses dollar cost averaging. So the client who ends up owning shares through a dollar cost averaging method of accumulation regarding any investment will always own shares 7 at a lower cost basis per share because the cost basis is protected. The share ownership is fluctuating versus the client who chooses dollar averaging. Am I right? Yes. Am I right? Yes. Am I right? Yes. Oh, I'm right. Yes. Thank you very much. I got to be right about this because I'm wrong about everything else. Well, client says, holidays are coming up. I need some liquidity. Go into my fund and redeem some shares. How many shares would you like me to liquidate and redeem? 1,000 shares. The NAV at the time of redemption, are you with me so far? Yes. On the sell side is the bid price the client receives when he liquidates. I'm telling you the NAV bid price is $5, NAV bid price per share. Are you with me so far? Yes. Client should get a check for $5,000. But there's a 1% redemption fee built into redemption at the time of redemption, which means what? We're going to charge him to liquidate. Are you with me so far? Yes. Some funds have a front-end load with a redemption fee built in, charging him on the way in and charging him on the way out. Am I right? Yes. Okay, so what if I told you this fund has a 1% redemption fee? 1% of the gross sale proceeds of $5,000 means his redemption fee to transactionally redeem is $50. And what's he going to net? $4,950. What do I want you to know? That the redemption fee is a percentage of the gross sale proceeds. Series 7, Bullet 1. Now, he said, listen, so okay, 1% is going to charge me $50. It's going to cost me $50 to redeem. Good. You're going to send me a check for $4,950? Absolutely. You want me to redeem 1,000 shares? Done. He said, listen, I want to discuss ways I can pull money out of this fund going forward with you. You know, my options on how I can redeem. Like, I would like you to sell 5 or redeem 5% of my fund's portfolio every quarter. Series 7, Bullet 1, liquidation based upon percentages. Are you with me so far? Yes. Did I ever tell you that in the neighborhood they called me Tony Gino? I got to tell you why. You know, you get these nicknames when you come from a borough because you are stereotyped based upon there's certain things that happen to you in life. Like Frankie. See, Frankie works in the cold cut store in a Latticini place. They called him Frankie Cold Cuts. Joey worked in a shoe store. They called him Joey Shoes. Me, they called me Tony Gino, and I got to tell you why. Everything I ever did in my life, especially when I was young, leading all the way up to now in my 40s, turned into and equivalated into and quantified into $1,000. It just always worked out for me that way. For example, I took my girl, you know, to Aruba last week, and you know, the tickets, they cost me $1,000 for the plane fare. We went to that restaurant, you know, Le Cirque, you know, with that Ciro Marconi guy. I got whacked out for $1,000 on dinner. We went to that Bloomingdale's white sale, you know, because she wanted to buy satin sheets for the bed. Cost me a G-note. So I swear, everything in my life always cost me $1,000. Always seemed to be around that, so they called me Tony Gino. So, hey, you know, I got this certain rep I got to maintain, you know, in the neighborhood. So here's what I want you to do. I want you to go into my mutual fund portfolio. I want you to liquidate as many shares as you need to. Just make sure that every month I get that G-note sent to my house, because I am Tony Gino. Liquidation based upon a fixed dollar amount of money. Hey, did I tell you I'm 59 years old and I sold my business finally after 3 years up for sale at Delancey Street? Yeah, got out of it. I'm getting out. Matter of fact, I'm moving to Miami. And I'm going to eat fish, I'm going to dance, and I'm going to live until I'm 90. I'm going down there with my girl, my wife, and my 2 daughters. So why don't you loosen up? Hey, look! By the time I'm 62, make sure I am no longer long a mutual fund portfolio. Series 7 liquidation over a period of time. These are ways that the client can pull out and redeem money out of a fund. They got me so far? Or redeem shares, or based upon a fixed dollar amount of money, or over a period of time. Now, I want you to know it's time for the tax ramifications of mutual fund trading. In the 3rd week of December, the management company, Dreyfus, is going to send your client a letter. This letter is his activity statement. Are you with me so far? Yes. Look up and look carefully. The activity statement has 3 columns. Column left talks about his average cost basis per share of his investment in the fund. Column middle talks about the number of shares that he owns in his portfolio. Are you with me so far? Yes. I want to talk about the 3rd column right here. Are you with me so far? Yes. The 3rd column, you might see $1,566.26. He doesn't quite know what that is. Mr. Johnson, that's the dividend income, the investment income that you've earned in the fund as a result of investing in common stock in your fund by the end of the year. So what do funds pay out? They pay out dividend income, investment income. Am I right?
Yes.
How is that taxed? Give me the two little letters now. At OI. Are you with me so far? Because we know investment income, referring to the dividend income that's being generated from the stocks that are invested in the fund, paid out to the shareholder, are taxed as investment income is taxed at OI in bracket, just like earned income is taxed. Am I right?
Yes.
So unless there's any potential capital gains from trading the position by redeeming part of the position, or you'll be so far, if not all, of the client's investment, and the dividend income, those will be the areas that are taxed to the investor. That's not on NASDAQ. Are you with me so far?
Yes.
But there's a very powerful tax regulation that's on the Series 7 exam. Well, it's not about the investor and his dividend income or any potential capital gains. Are you with me so far?
Yes.
Who's it about? Dreyfus. You got to look up for this one. Let me show you how mutual fund shares are sold to the open market. You know their pricing and valuation. But I want to show you where everybody is making money. Watch this very carefully. You've got the management company, Dreyfus. They're the creator of the fund. Are you with me so far?
Yes.
They're going to sell those shares to a sponsor, Merrill Lynch. Are you with me so far?
Yes.
And look at the price they charge the sponsor, the NAV. So Merrill Lynch is buying those shares from Dreyfus at the NAV price. Are you with me so far?
Yes.
Right there, at this point, this is where the management company makes money. From however much it cost them to create those shares, are you with me so far?
Yes.
And the amount of money they receive when they resell those shares to Merrill Lynch. Are you with me so far?
Yes.
Now, what's Merrill Lynch going to do with those shares? They're going to resell those shares to Mr. Johnson. Are you with me so far? The client. And what's the client going to pay? The public offering price. And so the difference between the cost basis that Merrill paid to own those shares from Dreyfus, known as the NAV was the cost to the sponsor, Merrill Lynch. And the amount of money Merrill receives from the client in the form of the POP, that's the profit to the investment bank broker-dealer sponsor. You with me so far?
Yes.
Now, where's the client going to make money? He bought those shares at the offer and then redeemed them at the NAV bid price for the potential capital gains. This is where everybody is making money. Am I right?
Yes.
What they're talking about is the tax ramifications too. Dreyfus, the management company. They're in the business of making money by selling those shares to a sponsor and charging the sponsor Merrill the NAV bid price, along with any income they're earning from shares that they're long on their books proprietarily. Am I right?
Yes.
Now, the IRS would like to exempt and has a tax law that is designed to exempt certain management companies from not having to pay a tax liability on the income and the gains that they're earning on their own investment books proprietarily. Are you with me so far?
Yes.
Just about every management company would love to be eligible for this tax exemption, where they don't have to pay a tax liability. Dreyfus would be exempt. The Dreyfuses of the world would be exempt from not having to pay a tax liability on Series 7. 90% of the dividend income they're earning on their own books proprietarily. Now, before we get into this tax law, I'm talking about one more time. Please look up the tax ramifications to Dreyfus. Are you with me so far? Are you with me so far?
Yes.
On the dividend income they're earning from shares that they own on their books proprietarily. Are you with me so far?
Yes.
I want to talk to you about mutual funds. I want you to know that mutual funds, listen to my words very carefully, are structured and designed and operated on what is called a flow-through conduit basis. These words should mean something to you from tax shelters. If any investment is structured and designed as a conduit security, that means that whatever goes on in the investment, are you with me so far?
Yes.
All of its financial activity flow down to the investor. A conduit is a connection between the shareholder who is invested in the security and the security itself. Are you with me so far?
Yes.
Limited partnerships operate on a flow-through conduit basis. Whatever goes on in the program flow down to the limited partner in the form of passive income or passive losses. Are you with me so far?
Yes.
Mutual funds operate similarly on a conduit basis. Whatever goes on in that fund is distributed and passed through and flowed down to the shareholders who've invested in the fund. So if a management company is eligible for this tax exemption, where they wouldn't have to pay a tax liability on 90% of the dividend income, the investment income they're earning on their own books, that means that that would be exempt to shareholders. That would ultimately flow down to shareholders who've invested in the respective funds. Therefore, why do we have the tax law exemption? It's designed to mitigate the effects of extra taxation or double taxation that would normally be borne by shareholders. Are you with me so far?
Yes.
Let's take a look at whom these special management companies are that would be eligible for this exemption. only what are known as regulated investment companies. I say investment companies, you think Dreyfus. What's dangerous about this language is that if we would think regulated investment companies, we would hear that terminology, we would think regulation. Are you with me so far? Yes. The word regulated investment companies, or RICs, has nothing to do with management companies who are highly regulated over other management companies. Are you with me so far? Yes. But it has to do with the assets and the amount of money they distribute at the end of the year to shareholders. Now I want you to listen to me, and I want you to look right here, right here. The IRS, here we go again with these guys, they print out a schedule at the end of every year. This schedule is a dollar schedule that management companies must meet on a distribution level of net investment income the fund is required to pay out to shareholders. If that fund pays out a certain dollar amount of money of net investment income, which is dividend income, and interest income minus expenses to shareholders by the end of the year, you'll be so far, and that distribution of that net investment income, that fund that pays out to shareholders, meets the IRS distribution schedule, only then would that fund be considered a regulated investment company and be eligible for a staggering tax law exemption of not having to pay a tax liability on 90% of the dividend income they pass through to shareholders by the end of the tax year. Now, I want to teach the strategy to you in this regulation from a different point of view. To use the analogy of a cause and effect, are you with me so far? Yes. What is the effect that every management company is looking to achieve? They're looking to qualify as being a regulated investment company. If they qualify as an RIC, then they won't have to pay a tax liability on 90% of the dividend income they're passing through to its shareholders to be eligible for this staggering tax law exemption. So, what do you think is going to cause that effect to be met? I have two management companies right here. Take a look at them. Management company number one, Fidelity, of the fund Magellan, with the asset base of $100 billion. And management company number two, Munder, of the management company's fund NetNet, with an asset base of $30 billion. Look up, listen to the question carefully. By the end of the tax year, which fund do you think has a higher probability of paying out a higher level of net investment income to shareholders? The shareholders invested in Fund A or Fund B? Take a guess. Fund A. Fund A. Therefore, what do you think is causing that distribution level to be met by the end of the tax year that meets the IRS distribution schedule? The size of the assets in the fund. The higher the asset base, the higher the level of net investment income, the higher the probability the fund pays out a certain dollar amount of money that meets the IRS distribution schedule to qualify as an RIC to be eligible for that tax law exemption. You want to know the definition of an RIC in English? I'll give it to you. Only the big boys. Look at me so far. Yes. The tax law that is designed to exempt certain management companies, known as regulated investment companies, from not having to pay a tax liability on 90% of the dividend income they pay through to shareholders by the end of the tax year, is known as 7, subchapter M, Conduit Pipeline Tax Treatment Theory. Wow, that's a mouthful, jeez. Can you say that again 10 times? You know it. Subchapter M, Conduit. Conduit. Why is it called the Conduit Pipeline Tax Treatment Theory? I'll tell you why. Because this theory, this tax law, is designed to eliminate the effects of extra taxation that the management company would normally be passing through to shareholders who've invested in the fund by not having to pay a tax liability on 90% of the dividend income. Now, I'm going to read this to you one more time. And we're under the area on 18, I think 28 in the body of your work. There's a picture of a guy there. He's got some hair, so you know it's not me. Are you with me so far? Yes. Looks like it's flowing in the wind. He looks like he's reading the ticker tape there. And it says there, investment income under him. Are you all there? Yes. Yes. There you go. Mutual funds operate on a conduit pass-through basis. We said that again. I said it 4 times, and I'll say it again. Whatever happens in that fund, look at me. Whatever happens in that fund, conduitly passed through to shareholders who've invested in the fund. There's a connection between shareholders invested in the fund and what's going on in the fund. Are you with me so far? Yes. That's called a conduit structure. Are you with me? Yes. The subchapter M of the IRS code, known as the Conduit Pipeline Tax Treatment Theory Regulation, that's a mouthful again, provides beneficial tax treatment to certain management companies, known as regulated investment companies. I would say that's beneficial, wouldn't you? The beneficial tax treatment is an exemption of tax liability on dividend income that management companies don't have to pay. Are you with me so far? Yes. Basically, if a management company like Dreyfus is known as an RIC, which means what? It paid out a certain dollar amount of money of net investment income to shareholders by the end of the tax year that meets the IRS distribution schedule. Are you with me so far? Yes. It would not have to pay a tax liability Series 7 on 90% of the net investment income on its books, and therefore not passed through to the shareholders, and therefore it's a staggering tax exemption. Are you with me so far? Yes. And so the only area on the tax ramifications of mutual fund trading is not to the mutual fund investor, but rather to the management company on this RIC tax law exemption on 90% of net investment income they don't have to pay a tax on that normally would be passed through to shareholders. Staggering exemption. Qualify as an RIC, you're eligible for the tax exemption. Dreyfuses of the world. Are you with me? Yes. Truly the end of mutual funds and closed-ended shares, but you know there's another security in the chapter. What is it? It is called a real estate investment trust certificate. The word certificate means security. Are you with me so far? Yes. Would you like to know what a REIT is? I'll tell you what a REIT is. It's a real estate mutual fund. Oh, the definition of a REIT is not on NASDAQ. They know you know that a REIT is a real estate mutual fund. Look at me. Instead of the makeup of the underlying portfolio built into the real estate investment trust certificate made up of stocks, it's made up of real estate mortgages. Are you with me so far? Yes. So when the client calls up and he wants to buy a REIT, are you with me so far? He wants to invest in REITs. He wants to invest in the real estate market. Are you with me so far? Yes. That REIT is going to pay out a return to the REIT holder in the form of dividends and interest and rents, along with the sale of the appreciated property that represents the portfolio of mortgages that underlie the real estate investment trust certificate itself. And that is the structure of a REIT. Are you with me? Yes. A real estate mutual fund. Now, REITs are very exciting right now. They're paying significant returns. We were recommending last week REITs with a 7% yield. Very attractive. Are you with me? Yes. So if the definition of a REIT is not on NASDAQ, and what is? The two different types of REITs that we have. Mortgage REITs versus equity REITs. By definition, NASDAQ Series 7 Bullet 1. Italicized. That means it looks funny. Are you with me? Yes. Second paragraph, second sentence. Third sentence, first paragraph. An equity REIT. An equity REIT, Series 7 Bullet 1, invests in a portfolio of real estate assets. And the investors receive income from Series 7 Bullet 2 rents and capital gain from the sale of appreciated property. Are you with me? Yes. That's pretty much straightforward. But a mortgage REIT is different. A mortgage REIT borrows money from a commercial bank and then lends that borrowed funds at a higher rate to building developers. That REIT is structured and designed and operated as a trust that passes through to investors, Series 7, at least 75% of the income coming from real property. 7. Equity REITs versus mortgage REITs. Are you with me? Yes. That's the end of this particular chapter. You looked at about 25 questions, both first and second half, on NASDAQ associated with mutual fund trading and all their regulations. Between that and the regulations associated with New York Stock Exchange, bringing money on limited partnerships and margin trading, you are now right in the thick of the height of what NASDAQ is really all about in these advanced products, these advanced strategies. Now, before we actually get into what we're going to do for Friday, let's talk about tonight. You have in front of you several documents. The first of which is known as my publication on the New York Stock Exchange. And the second is my publication on mutual funds. Are you with me so far? Yes. You have that documentation in front of you, yes? Yes. You also have in front of you 2 chapter exams followed by the answers and explanations. The first is called a Trading Markets Chapter Exam of 55 questions covering the regulations associated with New York Stock Exchange and many order qualifier type questions that is consistent with NASDAQ's experience. Second school of training, remember, is that transactional component, open book with answers. No stress, no testing, can't fail anything with me, right? Right. The second is a 60-question investment company chapter exam, transactionally, just like NASDAQ's experience on the regulations associated with open-ended shares versus closed-ended shares. Your lesson for tonight and your lesson for tomorrow to get yourself ready for derivative day on the option side is as follows. Tonight, step 1, let's reread 11 and 18 with a newfound language behind us in education. Step 2, the notes. And there were many. Right? Right. Right. Thank you. 11 and 18. And then the notes. Step 3, I want you to read my publication on mutual funds and then my publication on the New York Stock Exchange. I want you to take a break after the reading. And then go back in after your break, however long you deem necessary, and I want you to perform the Trading Markets Chapter Exam open book, and then the Investment Company Chapter Exam open book. That's about 4 hours tonight, and it's critical to capitalize on today's education. Are you with me so far? Yes. And that's enough from tonight. Questions, sir? One more time. You got it. It's a reading of 11 and 18. It's the reading of the notes, these selective areas. It is the reading of my body of work on New York Stock Exchange and mutual funds. It's a break. And then we go back in on the chapter exams, open book, of the investment company chapter exam and the trading markets chapter exam, open book, to review not only educationally and theoretically, but transactionally. Are you with me so far?
Yes.
It keeps us theoretical and transactionally warm and strong. Now, let's talk about tomorrow. I don't want you to worry about the options. I have surprises for you that are beyond your wildest dreams. Are you with me so far?
Yes.
I want to start time on Friday at 10:45 a.m. sharp. Can we all make that?
Yes.
If there's anybody in this room that can't make 10:45, I will not start it at 10:45. I'm not missing anybody here. Are we good?
Yes.
Please be on time. Don't be late. Now, tomorrow night, I want you to read chapter 16, which is called The Fundamentals of Options. I don't think you'll have much of a problem associated with the fundamental reading there of what is a call and what is a put option contract. A little bit about the magic of the premium. A little bit about what are spreads and straddles. You'll read in chapters 14 and 15 right after the reading of 16. So read 16, then read 14 and 15. 14 and 15 are written a little heavy, just like any other experience. With respect to the language associated with spreads and straddles and the advanced hedging strategies of derivatives. I suspect, if you'll just allow me one more second, Crash, to do the best that you can to get through the reading. I promise you, I'm training it for and trading it for many years. You're not going to have a problem when it comes to Friday night. You're going to have these options under your belt with a strong education behind you, because I have a powerful surprise that I'm not telling you about right now. All I want you to know is this. It's a significant area. There's no question about it. It is the 1-2 punch to NASDAQ in addition to the fixed income bond side. And I can't think of a better day with beautiful weather to go into derivative trading. And you're going to have a massive amount of training. All I want you to do is try to get through the reading of 16 and 14 and 15 the best you can. I don't want you to panic, and I promise you we'll start going into contract trading, and I'll make it simple. I'm also going to do a transaction with you on Friday that I'm going to assure you that once this transaction is completed, you will see just how dynamic and financially impactful options could be. The transaction that I'm going to do with you on Friday is not a significant transaction with respect to a dramatic move in stock prices in the market, a move that normally we can see from any moment in trading on any given day. That is not too hard and too much to ask for, but that will change your client or yourself financially and your net worth. That is life-changing. Wait until I do that trade for you, and you see just how much money you can make with these derivatives. I'll see you on Friday. Do the best that you can. Keep yourself focused. Give yourself a round of applause. I'm proud of you.